What's going on, everybody? Thumbs up if you can see me, if you can hear me. Turn those cameras on. Let me see those beautiful faces. What's up, Rosa? What's up, Natasha? We got Gowan in the house, Jennifer, Christopher, Lenovo. We got Ish. We got Hormith. We got Jan. We got Trayisi. Is that right? Trayisi. I like the thumb up. Wendy's in the house. Turn these cameras on. I want to see some vibes here. Ian Lawrence, Fred. Looks like got some new faces here. Eric Autry, good to see you. Bill Lapham. Fantastic. All right, look, I want to see cameras on. I even dressed up for you. Actually, I wear this for my my Academy members, and I teach on Mondays. So I just came from our crypto course, and before that, I was in our Life Accelerator course. So I've been teaching for the last couple hours, but I wanted to do this live call tonight because of everything that happened over the weekend. But I just didn't want to talk about the drama. I want to talk about how there's money to be made on the back of these crises. Has anyone ever heard the expression, never let a good crisis go to waste? Has anyone ever heard that expression? Well, look, when it comes to investing, you have to think that way. And, you know, we are in a buyer's market right now when it comes to certain technological protocols. And right now in our investment club and in our crypto and DeFi academy, we are seeing some incredible opportunities. And right now, the rest of the street and the rest of the market is unable to take action on those opportunities. So we are seeing some of the most incredible deals right now. Inside our investment club, we're actually investing $1 million this week into 3 different protocols. And the reason we're doing it, we're getting incredible deals that we think, you know, one year, 18 months from now are gonna just be total slam dunks. And the reason we're doing it is because most of the valley, most of the world got burned last year on their investments, and they're not able to fund some of the most promising companies. And because of what happened over the weekend with Silicon Valley Bank, there's even more opportunities now for some well-placed, intelligent investing to have these massive asymmetric returns, bigger than anything you're gonna see buying Bitcoin or Ethereum or Sandbox or any of those cryptos. And I love them. I've had their leaders on my show. Okay, I love all those protocols. I'm in Paris at the Blockchain Week Summit next week. I'm going to meet all of these people. They've got great protocols, but all of the public tokens, it's not the way to make the big money. If you want to make 100x, 200x, 300x returns on your investments or more, you have to be involved in early stage deals. That means private sale tokens or early stage equity deals. That is where the opportunity is. And because of Silicon Valley Bank, we're seeing tons of that right now. Does that make sense to everybody here? Just thumbs up would make sense. Thumbs down if you have no idea what I'm talking about, because that's okay, because I'm going to explain a little bit of that today. I'm also going to talk about what happened with Silicon Valley Bank, because I was a banker for many years. Please forgive me for being a greedy banker for so many years. I think I've atoned myself with 11 years of broadcasting on London Real. Maybe I got a couple years left. But look, I saw the worst of the worst, right? I was started on Wall Street in 1993. I was a derivatives trader on the fixed income book. I traded billions of dollars of US Treasuries, so I understand the US Treasury yield curve. I dealt with lots of financial institutions as customers, so I understand regional banks like Silicon Valley Bank. I understand capital calls. I understand runs on banks. I traded credit derivatives in London during the financial crisis of 2000, 2007, and 8. I made a ton of money because there was a lot of volatility. And again, never let a good crisis go to waste. I had a lot of dealers that had to move positions, and I made a ton of money. And I saw banks go bankrupt. One of my biggest customers at the time was Lehman Brothers. Does anybody remember the name Lehman Brothers, right? I literally had about 6 traders at Lehman Brothers that were my best friends, and I had covered them for years. I had one that traded bank credit default swaps, one that traded industrials, one that traded telcos, one that traded chemicals. And I remember they all called me up one day and they're like, Brian, we were given cardboard boxes and we're told to leave the office in the next 40 minutes. And I was like, serious? And they're like, it's over. And I was like, wow. I saw it all happen in front of my eyes, and these were all my counterparts. And so I watched what happens when there's a run on the banks. I've seen the consequences. And this weekend, I was deeply in touch with some of the highest levels of people involved in the game here. People like with deep connections into lots of VC, into the banking, even people that knew what was going on behind the scenes. So I followed it, and I kept my mouth shut until today. And I wanted to talk to you about what I learned and how we can position ourselves going forward with everything that happened this weekend. All right, sound good to everybody here? Ask me any questions you have in the chat. Turn the cameras on. Martini, if they don't have the camera on, feel free to just throw them out. Just throw them out of the room. Banish them from future Zoom calls. You don't have to wear a tie if you want. I appreciate it. You know, Dieter, you're looking good. Bill, you're looking good. Peter Vicente, you're looking good. Thank you. And let's jump into it. All right. I literally threw this presentation together this morning. So if it's a little rough and ready, it's because I literally just put it together. But let's start here. Can everybody see this? This is our presentation for the day. Thumbs up if you can see it. This is an AI generated image of me. We're making some AI investments in our venture investment club. So I've been playing around with the art. I'm actually much better looking in person, but this is the image. And today I want to talk about how the Fed has rescued the failed Silicon Valley Bank depositors, how to profit from this market volatility. I want to talk about what happens. I want to also talk about how you can position yourself for incredible gains, right? The rich know how to get wealthy in times of tragedy, all right? What do they say when there's blood on the streets, you buy real estate? Has anyone ever heard of that expression? That's what all the wealthy families say, right? So if you know how to do this right, you can take advantage of this. If you want to curl up in a ball and go cry in the corner and lick your wounds, that's what most people do in times like this. Let me tell you, that's not how billionaires are created. And by the way, millionaires and billionaires are created in the bear markets. The majority of them were created in the bear markets, not in the bull markets. Is that clear for everybody as well? In the bull market, everybody and their mother is getting rich, right? Everybody's got some coin they're shilling. Everyone's got some NFT they're trying to throw at you, right? Everybody's making a buck. In the bear market is when the true players come out. And if you're building and investing here, that's when you make the real wealth. So let's look at what happened today. Also, we're investing in 3 hot deals. We're putting over $1 million, and I'll share with you what we're investing in and why. So you can start to see the patterns if you see these things out there that you can participate in. So today I want to talk about 3 things, all right? We saw technology startups wobble on Silicon Valley Bank scare. And so now is the time to double down. That's my question for you, okay? The next thing I want to talk about is we've seen crypto markets rally massively on the back of that news. Does everybody watch Bitcoin pop, Ethereum pop on the back of this news? But will this continue, and how will this continue? I want to tell you why. And the other thing we saw, there was big news this weekend, as if Silicon Valley Bank wasn't enough. We saw the stablecoin USDC Depeg from $1 to 88 cents. Now, I've had Jeremy Allaire, the CEO of Circle, on my show. And to watch that stablecoin, considered the most robust stablecoin in the world, to go from $1 to 88 cents, which is a big deal, by the way, that was massive to see. And the question is, will CBDCs now get fast-tracked on the back of that? All right. How many people watched the USDC depegging over the weekend? All right. It was a big event in crypto, and we'll talk about it here. So let's get down and dirty, and let's talk about what actually happened. By the way, raise your hand if you think you know what happened. Just raise your hand. Okay. Some people know what happened. Some people didn't. All right. Let me tell you what I think happened. I think I'm pretty accurate here. So what actually happened? Well, look, on Thursday, Friday, we started to see that the Silicon Bank panic was going to turn into a real thing. Now, Silicon Valley Bank is like the 16th largest bank in America. It's a regional bank in Silicon Valley, but it primarily is involved in tech investments, venture capital. That also means it's the bank of choice for venture capitalists, where they put billions and billions of dollars of their limited partners' money in for investments. It also is the bank that loans money to tech startups, and it's the place where tech startups keep their money. It's also big in the wine industry, which is big in Napa Valley, if you've ever been there in San Francisco, all right? It's a big bank. They also have branches here in London. I actually interviewed one of their people back on my show about 8 years ago on a show I had called Silicon Reel, where I was looking at tech. So they've been around since 1983, very new bank, but they were heavily leveraged in the tech industry. And they were also subjected to the fact that the US yield curve has changed significantly in the last 6 months, which means rates used to be basically 0 or 1%, and now they're basically 4 and 5%. And when you change rates that much, if you're a bank and you've been buying these long-term treasuries, you get to a point where actually you're having a problem, and you're having a hard time trying to justify the assets that you bought on your balance sheet. So panic started to happen. The bank decided they were going to sell some shares in the bank to raise some money, and they screwed that up. And panic is like somebody yelling fire in a crowded theater. Does anybody know that analogy, right? I'd have to check the Supreme Court, but I think it's illegal to yell fire in a crowded theater, even though you have freedom of speech, because that one statement can cause a bunch of people to get killed when they don't need to get killed. And with fractional banking, any bank, when people make a run on it and take their deposits out, will make the bank fail by definition, because the bank will lend out 10 times more in deposits than what they have. And they lend them out in illiquid loans. And if everybody wants them there, if there's a panic, it's over. And in this age of social media and Twitter, panics that used to take a week or 2 weeks now can take a couple hours. And that's what happened last week with this bank. It all happened super fast. They had a call with a bunch of their really wealthy investors like Peter Thiel, who I will feature later on this presentation. And they said, please, you've done business with us for 10, 20 years. We've always supported you. We've given you loans to your crappy tech startups when you didn't deserve them. Please, please, please don't take your money out. And they said, okay, no problem. We've got your back. And they hung up the phone. And what did they do? They pulled out $40 billion in deposits because they said, I'm not taking the chance. And this thing was looking like it was going to crash. Okay. Now, here's the problem is that the federal government only guarantees deposits up to $250,000. Now, any CFO with their salt should know that and should never keep more than $250,000 in an unsecured account in a bank. But guess what? They all screwed up. 97% of those accounts had more than $250,000. So it meant a lot of people were going to lose a lot of money and they were never going to get it back. Is everybody clear so far? All right. This is 65,000 tech startups and London as well. There's a UK branch that weren't going to be able to make payroll next week. They lost all their money. Not to mention people that put money in their funds, not to mention other things like the circle deposits, which we'll get to. All right. So over the weekend, which is when they like to decide these things. On Friday, the stock price of the bank basically went to zero. The FDIC suspended it. The bank looked like it was going bankrupt. It was worth zero. By the way, it was worth like $100 billion 6 months ago. I mean, this is a big, massive fall off. And now everyone was scrambling. What's going to happen to the deposits? They locked the bank. And everyone's panicking, right? This is classic. Happens once every 20 years, right? It's pretty normal, but it's not nice if your savings is in there, that's for sure. So what happened? Over the weekend, the Fed's like, we're not bailing out banks anymore. We're not saving banks like we did during the financial crisis. But then they realized if they don't do this, every regional bank in America, the same thing's gonna happen because everybody's gonna yank their money out of that. And once they pull that money out of there, they pull that out of the money there, there's a complete crisis. There's a run on the bank. Everyone panics. There's no money in the system and the economy goes down the tubes. The next thing that happens is that China takes over all of the technology because America has got no tech startups anymore. And it's a national security issue, in my opinion. And that's why ultimately, late last night, the Fed stepped in and decided that they were going to make sure the banking system is safe. So the FDIC came out and said they set up this special program that basically is going to take the assets of the bank and hold them to maturity and guarantee every single deposit at Silicon Valley Bank, which means no matter how much money you had in there, when it opens up this morning in San Francisco, you can go in and do whatever you want with that money. It's as if nothing happens. This seamlessness is crucial because if some say they should have done this Friday, and they should have, because it already panicked people and scared people. But this means that hopefully things can continue without any problems and people could continue to develop and innovate. Is everybody following me so far? Thumbs up if you can still follow me, all right? This is crucial, okay? Let me just stop and pause this for a second. So you have to calm everybody down because panic can kill everything, right? If everyone panics, like I said, everybody in the theater gets trampled, even if there's no fire. And so they had to calm things down. Now all the Bitcoiners are saying, stop printing money that the taxpayer pays for, mostly low-income people pay for, to save these tech people that voted Democrat. So it was just Biden taking care of his own people. But like, honestly, I think they did the right thing because if this didn't happen, we would have seen markets globally come off. It would have been panic, it would have been buy, it would have been pain. And if we're on the edge of a recession now, we're going fully into a recession. And also would have been, in my opinion, a national security issue for America. America is already behind when it comes to crypto and DeFi to everybody else in the world because of their lousy regulations. Thank you, Gary Gensler, if you're watching. This would have taken them further behind. So this would be just literally a death knell in technology, which is the future, which could literally ruin its competitiveness as a nation. Everybody with me here so far? Okay, so let me continue. So they back the deposits. That doesn't mean, by the way, they save the greedy bankers. The greedy bankers at Silicon Valley Bank lose all of their equity. They lose their shares. The people that loaned them money lose their bonds. So they go to zero. It's not like when they saved Citibank back in the crisis or Goldman Sachs or Merrill Lynch or Bear Stearns. It's not like they saved the bankers and saved their equity holders. This is them saving the depositors. So it is a little bit better. It actually is. Now, some people say it's the same thing and it encourages people to gamble anyways. Maybe, but I think this was probably the smartest thing to do. I really do. So let's go on and look at what happened today as markets opened up. So now, today, as markets open up, bank stocks continue falling despite the emergency measures. All right. The world is still worried that all of these regional banks have the same problem Silicon Valley Bank does. They have a mismatch of assets. They're not going to be able to continue funding their deposits. And if there's any more runs, they're going to have failure after failure after failure. And even if the federal FDIC insures them, there might not be enough money to insure it. Although the Fed can always print money, there's still panic in the marketplace. And this is what we always expected. So this is putting more panic, more recessionary pressure on the entire system, which in my opinion means there's incredible opportunities to buy some of the most incredible companies on the cheap, because a lot of companies are going to fail right now. And some of the great tech companies are now looking for funding. They just need funding to make it through the next 6 months or 12 months. And you can do that. You can drive a hard bargain if you're willing to do that. Is that clear for everybody? You can get a huge chunk of their business for a small amount of money. Now let's go back to the end of 2021 when Bitcoin was at 69,000. I couldn't even get a phone call back from these companies back then. Why? Everyone was throwing so much money at them. They were the hottest deal in town, right? Pumping money, pumping money, pumping money, pumping money. I couldn't even get a phone call returned. Nowadays, we are getting our calls returned. So this is a buyer's market and we're taking advantage of this right now. We have to be careful, yes, but we believe there are literally generational wealth type opportunities happening right now in this market. If you can choose intelligently, you're going to take some risk. You're going to put your capital at risk, but we see payouts that are not going to be available in the public markets and in any cryptocurrency right now. Understood? All right, let me show you more. Next thing I want to talk about is the crypto markets are rallying massively. This is point number 2. But will this continue and how? This is fascinating, okay? So Bitcoin, look at this, crazy. Bitcoin is now higher than it was before the panic on Thursday last week of this bank closing. Why? Why? You might ask yourself, why? Bitcoin is on fire right now, blasting through 24,000, threatening to go up to 25,000. It's that which would be a high. It's high in like 9 months or something. What's going on here? Well, the Bitcoiners are laughing. They love a good crisis because for them, it shows everything flawed about the banking system, about the fractional reserve system, and about fiat currencies. It shows the Fed printing money to bail out yet another problem in banking, yet another fraudulent management. And guess who pays for it? Not just you, the taxpayer, but who really pays for this? Poor people pay for this. That's who pays for this. When inflation goes up, who pays for it? Rich people? No, poor people pay for this, right? When they write benefit checks for people, who pays for that in the long run? Poor people pay for this, right? And they're just saying this is all over again. They're just printing money all over again. It just it looks like something different. And guess what? They're right. This is just like printing money. It's just called something different, but it is just printing money at the end of the day. That's all it is. Somebody had to write a check and they wrote a check. Now they're saying it's only for this and it's for this. Okay, but they're still writing a check. So what does this mean for Bitcoin? Well, some are saying this is the first real world example to show financial institutions that Bitcoin is the stable coin of choice, right? That was the joke over the weekend between Michael Saylor, who's been on our show twice. He said, it's not USDC, Bitcoin is the stable coin of choice. That's an interesting point because the stable coins, those were falling potentially to zero. Bitcoin was the only asset that you might actually have a chance of holding their value because your savings in your bank were potentially going to zero. Does everyone see what's going on here, right? My friend Grant Cardone was on there saying, look, this is why I hold real estate. I don't want some numbers on a balance sheet in some institution that could be disappeared to zero. I want something like a house on a block that they're not going to take away from me. That's an asset. And you know what? I felt the same way. I got London Real. I got a business. You can't take this away from me. This is me. This is all of you. This is my content. This is my academies. This is our outlook. This is our ventures program. This is our investment club. I'd rather have this than money in a bank, right? I have an asset. I have a cash flowing asset. So all of a sudden, the banking system doesn't look so nice, doesn't look so safe, and assets start to look interesting. So some say this was the best use case for Bitcoin that's ever been seen. Does that concept make sense to everybody here? So this has been interesting to see this rally, and they might be right. Ethereum up even more than Bitcoin. Why is that? Well, Ethereum is the equivalent of decentralized finance. Bitcoin is not. I love Bitcoin, but it's digital gold. Okay, it's digital gold. Ethereum is digital technology play. It's a digital technology play. Ethereum is programmable. All right, it represents the future of decentralized finance. And all of my very famous guests, billionaires who have been on my show talking about decentralized finance, they all chimed in this weekend saying, guess what? DeFi didn't fail. Who failed? Centralized financial institutions run by folks that are greedy, that are not managing their risk. That's who failed. And do they have a point? Yeah, maybe they're right. Maybe they're right. All right. So I just want to stop this screen share really quick. Does that make sense to everybody here? We are really seeing potentially the market telling us that DeFi is the future, that DeFi showed a use case where this wouldn't have happened. DeFi would have had everything on the blockchain. I literally could have seen all of Silicon Valley Bank's assets. I could have seen those dodgy mortgage-backed securities they were holding. I could have seen the mismatched duration. I could have seen the treasury bonds they bought at 1% yield for 30 years that are now in the toilet by 4 and 5 points, right? And the depositors, they're paying 5% and their assets are gaining 1% and they're losing money every single day. They weren't telling me that, but I could have seen that on the blockchain. They're making some very good points here, all right? So crypto has had a real massive boost. It's had to push forward, but we're still potentially in a recessionary environment, all right? And that's not gonna be good for anybody, including crypto, in my opinion. So let me show you what this means. And then of course, how we can make some money on it. Third part is the stablecoin USDC depegging to 88 cents. And will that mean a fast track of CBDCs, which not everybody wants at this point? This blew my mind. Can everybody see what happened here? This is the USDC stablecoin. Now look, I'm giving you a graph from 7 days, but if you took this back to 3 years, you would see this peg basically never left 1. This was considered the gold standard of stablecoins. By the way, raise your hand if you know what a stablecoin is. Just hold your hands up. If you don't, that's okay. A stablecoin is a crypto invention that happened about 3-4 years ago. When I first interviewed Max Kaiser on Bitcoin 10 years ago, and I bought my first Bitcoin, stablecoins didn't exist. So if you own crypto, it was up and down every single day. You didn't know what the hell to do with it. About 4 years ago, someone invented a coin that was pegged to the US dollar. What an amazing idea, right? It was pegged to the US dollar. And Circle made one that was backed. We thought, Jeremy Allaire told me, 1-to-1 with US treasuries. And it was audited every single month. USDC was considered the gold standard of stablecoins. As in, if you minted 1 USDC and gave them $1, they would buy $1 worth of treasury bonds and hold it in a custodial account. Does everyone see that? Pretty safe, right? Not totally safe. If Jeremy Allaire goes to the Bahamas, then maybe I don't see that money. But, you know, pretty safe. There was another stablecoin called USDT, Tether. Does anybody here have any Tether? I know you do. I know you own some Tether out there, right? Now, everybody was pointing to Tether saying that's all the Chinese money. That's offshore. We don't know who the CEO is. We've never seen the audited accounts. We don't know their collateral. And guess what? Tether went above $1 this weekend because everybody was putting their money into Tether because all of a sudden the ugly stepchild stablecoin looked good because what happened with USDC? Jeremy Allaire of Circle comes out and says $3 billion of our reserves out of, they got about 39 billion or 30 some billion of stablecoins. $3 billion is in Silicon Valley Bank. What? What? Who's your CFO? How can you put 3 billion in a bank account that's unsecured? At least you told us it was in treasuries. If you're the CEO of a competent company, it should be in treasuries or in a brokerage account that's insured higher or spread it across many accounts, each with their own insurance up to 250 or $1 million. You never, ever, ever do this. And that's what they did. So what happened? It destaked about 10%, which is about their reserves. I looked at this. I couldn't believe what was happening. I talked to my buddy at a hedge fund in New York City of Saturday morning. He buys distressed assets and it was at 91 cents. I was like, you gonna buy some? He's like, I'm thinking about buying some here. I'm like, how could they hold that? What the hell, right? It didn't make sense. It looked like a good buy, but you know, Luna looked like a good buy at 91 cents too, and you got smoked as it goes to 0. So it's one thing to say it looks like a good buy. It's something to put your money where your mouth is. Did anybody here buy USDC at 91 cents? I don't know many people that did. Okay. Everybody was scared shitless. They were panicking. They didn't know if they get their money back, if the VCs were going to be taught a lesson to let their Silicon Valley Bank fail. So it wasn't obvious, but what happened? They came out and they said, by the way, owned by BlackRock and all this stuff. They said, we'll cover it with our own money. So it went up a little bit, but anybody could say that. And then when it looked like the Fed was going to make them whole last night, Sunday night, it started trading up to 97, 98 cents. Now it's basically back at par. So there you go, folks. Exciting times. What do the Chinese say? May you live in interesting times. I never saw that coming. And so the question is, what does this mean for all of us? That's what we need to know. And in my opinion, this means there's an incredible opportunity because the world is scared. Regional banks are still going to play out. I think some more are going to fail. And if VC funding wasn't already severely cramped, and it is right now, it's cramped even more, which means buying opportunities right now for us. It's an incredible time to make intelligent, very surgical, specific investments in companies that we believe are going to be, the next unicorns, the next DECA unicorns. We're looking for our companies to become $10 billion companies. That's what we're looking. So I want to show you how we're doing this. If anyone want to see how we're doing this, I'll show you how we're going to do this. Okay. By the way, any questions, put in the chat and I'll answer them at the end. So again, there is a lack of capital in the system, making this a buyer's market. There was honestly last week. That's why we were seeing this deal flow. Now it's gone up a lot. So we're in a beautiful situation right now, me and the members of our investment club, because we've got 50 people and with small amounts of capital, with $5,000 here, 10 grand here, these people, we can make significant investments in these companies and get large percentages. So when the market comes back, and it always does come back, the market's always cyclical, then the bull run happens and you're going to get these incredible outsized gains. This is the instrument, is a force multiplier for those gains. Now, look, you can buy Bitcoin right now. How many people think Bitcoin's going to 10x in the next year? Put your hands up. 10x. Come on, 25,000 to 250,000. Jay Scott, very bullish. You and Tim Draper. Not in a year. Not in 2 years, I don't think. Maybe in 3 years. Is it going to 100x in 5 years? I don't think so at this rate. But our investments can. So that's why we're looking at them, because we think they're a force multiplier. So we're